In this video, we look at how to perform an analysis of profitability. At the end of the video, try to test what you have learned with one of the business case studies you can find in this channel. First of all, as you probably already know, the equation to use whenever it comes to doing a profitability study is profit equals revenue minus costs. What you absolutely must keep in mind, however, is that profit analysis should always be done specifically to each product or business line of the business we are analyzing. For example, if a company has observed a drop in profit, it doesn't make sense to immediately dive into doing revenue and cost analysis. First, we'll need to learn about the products the company offers and analyze, when possible, the profitability of each segment. To remind us to inquire about the business model and the different sources of profitability, let's put a summation symbol in front of the equation. At this point, there are two ways to analyze the revenue minus cost equation. First, we can analyze the components of the equation as they are written. We start with revenue. Information about the revenue streams and their trends can give you important insights into the business model you are analyzing. Let's imagine that a decline in profit has been observed. If the problem is in revenue, then you will need to look at the two elements that make up revenue. These are price and sales volume. To improve profitability from a revenue perspective is a growth issue. Growth strategies will be covered separately in another video. If the problem is not in revenue, it will be necessary to look at costs. Costs are divided in fixed and variable. Fixed costs are independent of the quantity produced. Variable costs are the costs associated with producing every single unit of product. Generally, cost analysis is easier if you rearrange the equation differently. The second way of analyzing the profit equation is margin-based. It means that we are trying to figure out whether a decline in profits is to be found in the profit margin. There are two elements in this new equation: price minus variable cost, and fixed cost divided by volume. The first term tells us that the profit declines if the price is similar to the cost of production. In the extreme case where the price is less than the cost of the single unit, each unit sold will have a negative contribution to the total profit. Remember that we are conducting this analysis at the level of individual products. It could happen that a company has positive profits overall, but has a product with a negative contribution to profit. It will be necessary to find this product and decide what to do with it. The second term tells us that a certain amount of sales must be achieved to amortize fixed costs. To solve profitability problems related to this term, it will be necessary to either increase sales or find ways to lower fixed costs. As final considerations, remember that the segmentation of the profitability equation does not need to be done necessarily at the level of product offered. Instead, you might look at customer segments. For example, for a bank that offers discounted bank accounts to students, who typically have less money circulation, the student segment might be a weak segment and might need to be reconsidered within a broader strategy that goes beyond pure profitability. Or you can look at time segments, aka seasonality. There are businesses in tourism that make positive profits in summer and negative profits in winter. In addition, don't forget that there are hybrid costs, somewhere between variable and fixed. For example, the discount that the fitness studio offers to all its new members is linked to the individual customer, but it is a fixed cost that must be amortized over the time the customer remains subscribed. Now that you have a better idea of how to analyze profits, we are ready to test your intuition with one of the cases you can find in this channel. Thanks for watching.